It is one of the oldest and largest companies you have probably never thought about. For more than a century, it has sat quietly at the center of the world's food supply, moving grain, crushing oilseeds, refining what ends up inside a huge share of what the planet eats. But on a winter morning in early 2024, a question about how it counted its own profits, and no crime any court has proven, erased $15 billion before lunch. It once called itself, without much exaggeration, the supermarket to the world. Not a startup, not a fad, not a house of cards, a genuine industrial giant, well over 100 years old. And on that single morning, its stock fell more than 24% in one day, its worst single-day drop since 1929, the year of the Great Crash. In a matter of hours, something like $15 billion of the company's value simply evaporated. There was no failed harvest. No factory had burned. No war had cut off its supply. The trigger was quieter and stranger, an accounting question inside one of its own divisions. This is a story about that question. It is not a story about a bankruptcy. The company is still standing, still enormous, still essential. And it is important to say clearly from the very start what this is and is not. No one was criminally charged. The company later settled with regulators without admitting or denying wrongdoing, and one former executive denies the allegations and is contesting them in court, where no verdict has been reached. This is the story of how an accounting method most people have never heard of, and no crime that any court has proven, was still enough to erase $15 billion before lunch. To understand what happened, you first have to understand what this company actually does, because it is not what most people imagine. At its core, it is a trader and processor of agricultural commodities, grain, corn, soybeans, oils. That is a business of enormous scale and razor-thin margins. The company handles staggering volumes but earns only a sliver on each one. It is the definition of a low-margin, high-volume giant, vital but not exciting, and not the kind of business that makes a stock soar. For years, that created a quiet problem on Wall Street. Investors like growth. They like high margins and a story about the future. A century-old commodity trader, no matter how essential, does not naturally offer either. So the company leaned into a different narrative, a division that was supposed to be its future. Instead of raw commodities, this segment sold higher-value specialty ingredients, flavors, proteins, nutritional additives, the kinds of products that go into health foods and supplements. It was branded as the growth engine, the high-margin future that would lift the whole company above its low-margin past. That segment carried the story. As long as it appeared to be growing and profitable, investors could believe the giant was transforming into something more valuable. And here we arrive at the technical heart of the entire affair, a concept that sounds boring but is where everything turned. Inside a company this large, the divisions constantly sell things to each other. One segment produces something, another segment uses it. These are called intersegment transactions, internal sales, from one of the company's own pockets to another. Now consider the crucial detail. When one division sells to another inside the same company, someone has to decide the price of that internal sale, and that price decides which division gets to record the profit. Charge a low internal price and the buying division looks more profitable. Charge a high one and the selling division does. The total profit for the whole company does not change at all. It is the same money either way. But how that profit is divided between segments is, to a meaningful degree, a matter of choices. It is a dial, and a dial in the wrong hands is a temptation. Think of it like a household with several jars of money on a shelf. The total in the house is fixed, nothing new comes in. But you can move cash from the grocery jar to the savings jar, and suddenly, the savings jar looks like it is growing impressively, even though the family is no richer than before. If outsiders were judging your household only by the savings jar and rewarding you for how fast it filled, you would feel a pull to keep moving money into it, whatever the other jars looked like. That is the shape of the temptation at the center of this story. Not stealing money, not printing it. Just quietly deciding which jar it lands in and letting the world watch the jar you want it to watch. For a long time, the arrangement worked beautifully for the company's image. The growth segment posted impressive-looking margins. Analysts pointed to it as proof that the old commodity giant was successfully reinventing itself. The stock carried a premium built partly on the promise of that division. Executives spoke of it as the future. Investors bought the story, and for years the story held. The numbers seemed to confirm exactly what everyone wanted to believe. There is nothing inherently wrong with a company having a star division, or with internal transfers between segments. Every large company does this, and it is entirely normal and legal. The danger appears only when the pressure to keep the star shining collides with the fact that the star's brightness can be adjusted by a dial that management controls. If a growth segment must hit certain profit targets to keep the whole narrative alive, and if the internal transfer prices are one of the levers that determine those profits, then a quiet, dangerous incentive is born. It helps to understand just how much weight a single growth story can carry on Wall Street. A company that is seen as merely stable is valued modestly. A company that is seen as transforming into something faster growing and higher margin can be valued far more richly for the very same underlying business. The difference between those two valuations can be worth billions. That gap is the prize, and it is why the story a company tells about its future is never just words. It is directly attached to the price of the stock. When so much value hangs on one division continuing to shine, the pressure on the people responsible for that division's numbers is not abstract. It is intense, quarterly, and deeply personal. According to what regulators would later allege, that is exactly the incentive that took hold. The claim, and it is an allegation, tested in a settlement and for one individual still contested in court, is that internal transfers were adjusted to move operating profit into the growth segment, making it appear more profitable than it truly was in certain years. Not to invent money out of nothing. Not to conjure fake customers, simply to shift real profit from one of the company's pockets into the pocket that Wall Street was watching most closely. If true, it would mean the growth story investors were paying a premium for was, in part, a matter of internal bookkeeping rather than genuine performance. For years, none of this was visible from the outside. The segment's numbers looked strong, the narrative stayed intact, and the company was widely admired. But regulators had begun to ask questions. And then, on a single morning in January of 2024, the quiet became a public rupture. The company announced that it was placing its chief financial officer on administrative leave, and that it was investigating its own accounting practices in that very growth segment, the intersegment transactions at the center of everything. It also disclosed that a regulator had requested documents. The market did not wait for details. It did not wait for an investigation to conclude, or for anyone to be charged, or for a court to weigh in. The mere fact that the company itself had flagged a problem with the numbers behind its most important growth story was enough. On that single day, the stock collapsed by more than 24%, the sharpest one-day fall since 1929. Around $15 billion of market value was gone before the afternoon. Nothing about the company's actual operations had changed overnight. What had changed was trust. Notice how little it actually took. The company had not announced a loss. It had not revealed that its factories were failing or that its customers were leaving. It had announced, in effect, that a question existed about the reliability of certain numbers, and it had done the responsible thing by disclosing it. That was enough to trigger the worst single day in nearly a century. Investors were not reacting to a proven wrongdoing. None had been proven, and to this day the company admits none. They were reacting to something more primal, the sudden realization that a figure they had trusted might not mean what they thought it meant. In markets, doubt does not wait for proof. It prices itself in immediately, and it does not ask permission. That is the pivot of the whole story, and it is worth pausing on. The physical company was exactly the same on the morning after as it had been the morning before. The same grain elevators, the same crushing plants, the same contracts, the same essential role in the world's food supply. Not a single silo was emptier. And yet $15 billion of value had vanished, because value in a public company is not built only on what it owns. It is built on what investors believe about the numbers. And the moment a serious doubt entered those numbers, the belief, and the money resting on it, came apart with astonishing speed. What followed was not a collapse of the business, but a long, grinding collapse of certainty. Investigators from more than one agency began examining the company's financial reporting, reaching back years. The company revised how it described the growth segment's performance. Its market value, which had stood near $37 billion, fell toward $22 billion, roughly $15 billion erased and slow to return. Lawsuits from shareholders followed, arguing they had been misled about the numbers. For a company used to being an unremarkable, dependable fixture, it became, for a while, a cautionary headline. And then, nearly 2 years later, in early 2026, the reckoning arrived, and here precision matters more than anywhere else in this story. The company reached a settlement with the securities regulator, agreeing to pay a penalty of $40 million to resolve the investigation into its intersegment reporting. Crucially, it did so without admitting or denying wrongdoing, the standard language of such settlements. Separately, and just as importantly, the criminal authorities closed their own investigation of the company with no charges filed at all. There was no criminal case against the company. There was a civil settlement and a payment and an end. The regulator did bring charges against 3 former executives connected to the matter. 2 of them settled. The third, a former chief financial officer, did not. He has denied the allegations, rejected the regulator's account of what happened, and is preparing to defend himself in court. As of now, a court has not ruled on his case. He is, in the eyes of the law, someone accused in a civil proceeding who contests the accusation, and nothing more. It is essential not to collapse that distinction. An allegation that is denied and unproven is not a finding of guilt, and this story does not treat it as one. So the full, careful picture is this. A giant company disclosed a problem with how one segment's profits had been counted. The market erased $15 billion in a day. Investigations followed. The company ultimately paid a $40 million civil penalty without admitting wrongdoing. Criminal authorities walked away with no charges, 2 former executives settled, and 1 continues to fight the allegations with no verdict reached. No bankruptcy, no proven crime, and yet an enormous lasting cost. The lesson of this story is quieter than the usual tale of corporate disaster, and in some ways more useful precisely because there is no villain confessing and no company in ruins. It is a lesson about how fragile a number can be and how much can rest on it. The most striking fact here is the gap between the operational reality and the financial one. The business did not fail. The crops still moved. The plants still ran. And still, $15 billion of value disappeared in hours. Not because the company stopped working, but because investors could no longer fully trust what its books said. There is also a subtler lesson buried in the mechanism itself, the one about internal transfers. It is a reminder that misleading a market does not always require outright invention. Sometimes it can be a matter of where real profit is placed, which pocket it is recorded in, which division gets credited, which story the numbers are arranged to support. That kind of distortion is far harder to see than a simple lie, because every individual transaction can look ordinary. The danger lies not in any single entry, but in the pattern, and in the pressure that shapes it. When a company's story depends on one division shining, and the tools to make it shine are internal and discretionary, the temptation is structural. This is also why these situations are so difficult to catch from the outside, and why they can persist for years before surfacing. An outside investor sees only the final, summarized numbers a company chooses to report. The internal machinery, which division sold what to which at what price, and why, sits far below the surface, visible only to those inside. Auditors and regulators can probe it, but it takes time, suspicion, and access. That opacity is not unique to any one company. It is a feature of how large, multi-segment businesses report themselves to the world. The uncomfortable takeaway is that a great deal of what markets rely on comes down to trust that the people setting those internal dials are setting them honestly. And that trust, by its nature, is very hard to verify until something forces it into the open. And finally, there is the lesson about trust itself, which is the real currency here. A public company's value is a kind of collective belief, a bet by millions of people that the numbers describe reality. That belief is enormously valuable and almost weightless. It can be built over a century and punctured in a single disclosure. This company will likely endure. It is too essential to vanish, and it has paid its penalty and moved on. But the morning it lost $15 billion is a permanent reminder that for a company whose stock rests on the credibility of its accounts, the accounts are not a formality. They are the foundation. And a foundation, once doubted, does not need to be proven rotten to bring the value above it crashing down. This video is for educational and informational purposes only. It describes a civil regulatory matter and is based on publicly available filings and reporting from credentialed sources. The company settled without admitting or denying wrongdoing. Criminal authorities filed no charges, and 1 former executive denies the allegations against him, which remain unproven in court. Nothing in this video should be taken as a statement that any individual is guilty of any crime. Source links are provided above.